Hello everyone, welcome back. And it's only been a few days since the latest silver delivery window opened, but already the conversation around COMEX has gone from normal market plumbing to full-blown panic, with people asking if registered silver is disappearing, if big banks are scrambling for metal, and if the paper market is finally running into the wall that physical buyers have been warning about for years. Today is Tuesday, May 5th, New York time, and before we get into the numbers, comment below what day and date you're watching from, because this market is moving so fast that even a few days can change the entire setup. And if you value this kind of clean, no-hype breakdown, support the channel by subscribing and commenting "Our John AG" below. So in this video, I want to separate what is actually happening in silver from what is being shouted on the internet. Because there is real stress here. There is real tightness. There is real concentration. But there is also a lot of exaggeration being mixed into the story. And when people blend good data with wild claims, the good data gets dismissed right along with the nonsense. And that would be a mistake. Because based on the latest publicly available filings, silver open interest on COMEX is not sitting in some ordinary zone. It has dropped to just over 100,000 contracts, after falling by a little over 14,000 contracts in one reporting week. Since each standard silver futures contract represents 5,000 ounces, that weekly drop is not small. It represents roughly 70 million ounces of paper exposure coming off the board. Now, does that automatically mean somebody defaulted? No. Does it mean the exchange is collapsing tomorrow? No. But does it mean traders reduced exposure aggressively right before a key delivery period while registered warehouse stocks were already low? Yes, and that is the part worth paying attention to. Because when open interest falls hard, we have to ask a simple question. Did traders roll because they wanted to? Did they close because price got volatile? Did they step away because margins became uncomfortable? Or did some of them quietly decide that standing for metal was not the game they wanted to play anymore? That question matters because silver is not trading like a sleepy industrial metal anymore. It is trading like a monetary metal with an industrial engine underneath it. Price is hovering in the low 70s after a violent move down from the extreme highs earlier this year, and yet the physical discussion has not gone away. In fact, it has become more important because the lower price has not magically created a mountain of immediately deliverable metal. And this is where registered versus eligible silver matters. Registered silver is the metal already marked as available for delivery against futures contracts. Eligible silver meets exchange standards, but it is not automatically sitting there for anyone who wants it. It may belong to someone who has no intention of delivering it. So when people add the two together and act like every ounce is equally available, they are making the market look looser than it really is. Recently published warehouse numbers showed registered silver in the mid 70 million ounce area, while eligible silver was a few 100 million ounces higher. Put together, total warehouse silver looked like a little over 300 million ounces. But the real focus is the registered category, because that is where the delivery pressure hits first. Now here's the first place where we need to be careful. Low registered inventory is serious, but it is not the same thing as an immediate failure. Exchanges are designed around rolling, offsetting, financing, delivery notices, warrants, and settlement mechanisms. A stress market can keep functioning longer than people expect. That is why I'm not going to tell you silver must break the system by some specific holiday, because that kind of date-driven prediction usually creates more confusion than clarity. What I will say is this. The setup is tight enough that the market no longer has much room for sloppy assumptions. If a large group of longs suddenly insists on metal at the same time that shorts are reluctant to deliver, then the pressure becomes visible very quickly. And when registered stocks are low relative to paper exposure, every delivery cycle becomes a test. This is why the concentration data is so important. The largest traders on the short side hold close to half of gross short open interest, and just under half of net short open interest. That does not prove illegal manipulation by itself. It does not name every firm. It does not tell us motive. But it does show that the short side is not spread evenly across thousands of small players. It is concentrated. And concentration changes the risk profile. Because when a few large players dominate one side of a physically deliverable market, the question becomes less about the average trader and more about the balance sheet, funding access, warehouse access, leasing relationships, and delivery discipline of the biggest players involved. In normal times, that structure looks efficient. In tight times, it can start to look fragile. Now, some people want to jump from that point straight to saying every move lower is criminal, every delivery notice is suspicious, and every bank is trapped. I understand why people go there, especially because the precious metals market does have a history. We have seen major enforcement actions in the past, including a near billion-dollar penalty tied to spoofing in precious metals and treasury futures. So distrust did not appear out of thin air. But past misconduct is not proof that every current trade is manipulation. That is the counterpoint we have to keep in the analysis, even if it is uncomfortable. A market can be concentrated without every move being rigged. A delivery month can be heavy without being a default. A warehouse number can be tight without meaning the doors close tomorrow. If we overstate the case, we weaken it, and the real case is already strong enough. Silver is still expected to remain in deficit again this year, which would extend a multi-year run of the market needing above-ground inventory to fill the gap between supply and demand. Mine supply is expected to rise only modestly. Recycling is improving because high prices bring scrap back into the market, and yet the demand side is still being supported by investment buying, electronics, automotive demand, data centers, and artificial intelligence infrastructure. That last part matters more than most people realize. For years, silver was discussed mostly as the forgotten monetary metal, but the new demand stack is different. Solar demand has been affected by thrifting and substitution, which means manufacturers are using less silver per unit where they can. That is bearish at the margin. But data centers, power electronics, advanced vehicles, grid investment, and high-performance computing are creating a different kind of floor under industrial demand. So silver is getting pulled from both sides. Investors want it because currencies are being diluted and real assets are back in favor. Industry wants it because modern electrification still needs highly conductive metals. And futures traders want exposure because volatility creates opportunity. Put those together, and you get a market that can look overextended on a chart while still remaining tight underneath. That is why I do not look at a pullback into the low 70s and automatically say the bull move is over. A price decline can clear leverage. It can flush weak hands. It can reduce speculative heat. And if physical demand remains firm after that flush, the next move up can come from a healthier base. But again, this is not a reason to be reckless. If you're successful, share your success story in the comments so others can stay motivated. But also remember that success in a market like this is not just about being bullish. It is about surviving volatility without letting headlines control your decisions. Now let's talk about the ETF confusion, because this is where bad information can really distort the story. One claim floating around is that the large silver ETF only holds around 100 million ounces. That is not correct. Recent trust data shows holdings closer to the high 400 million ounce area. That does not mean ETF metal is the same as coins in your hand. It does not mean every retail investor has a direct claim on a bar. But if we are going to discuss silver supply, we cannot shrink a major trust by hundreds of millions of ounces just to make the scarcity argument sound more dramatic. The truth is dramatic enough without doing that. There is a lot of silver in ETFs. There is a lot of silver in eligible warehouse categories. There is silver in London. There is silver in private hands. But the key issue is not whether silver exists somewhere on Earth. The key issue is how much metal is available, at the right location, in the right form, under the right ownership, at the exact moment delivery demand appears. That is the squeeze point. This is why I prefer physical silver as a long-term position, not because I believe every paper instrument is fake, but because physical possession removes several layers of counterparty risk. With coins, rounds, or bars you personally control, you are not depending on a broker, a clearing member, a trustee, a custodian, or a delivery chain. You still have storage risk. You still have liquidity risk. You still have premium risk, but you know what you own. And in a market where trust is becoming expensive, knowing what you own has value. Now, let's bring this back to the delivery month. The big takeaway is not that one named bank is secretly saving the system, or that another one is about to be exposed. Unless we are looking directly at official delivery notices, house versus customer accounts, and the full sequence of issues and stops, we should not pretend we know the hidden motive behind every transaction. What we can say is that delivery activity is meaningful, open interest has fallen sharply, registered stocks remain tight, and the short side is highly concentrated. That combination deserves attention. It also deserves discipline. Because silver investors have been trained for years to expect a straight line from tight inventory to instant explosion, and markets almost never work that cleanly. Sometimes the pressure shows up in price. Sometimes it shows up in premiums. Sometimes it shows up in lease rates or spreads. Sometimes it shows up in sudden rule changes, higher margins, or strange inventory movements that only make sense later. So my focus right now is not on one dramatic deadline. My focus is on whether registered stocks rebuild, whether open interest expands again, whether deliveries keep draining available metal, whether ETF holdings rise or fall, and whether the silver deficit continues to force metal out of above-ground inventories. Those are the indicators that matter. If registered silver starts rising meaningfully while open interest stays low and investment demand cools, then the stress story weakens. If registered silver keeps sitting near tight levels while price stabilizes and demand returns, then the pressure builds again. And if we get a fresh wave of longs willing to stand for delivery during a period when shorts are already crowded, then silver could move faster than most people are prepared for. One more thing matters here. A strong silver thesis does not need a broken exchange to work. It can work through steady deficit, rising replacement cost, cautious mine growth, and buyers slowly choosing physical metal over promises. That kind of repricing can be quieter at first, but it can also be more durable because it is not built on one dramatic event. It is built on repeated shortages meeting repeated demand, month after month, in the real world today. That is the real cliffhanger. Not aliens, not mystical politics, not guaranteed confiscation, not a countdown to collapse. The cliffhanger is whether a market built for financial hedging can handle a growing number of participants who no longer want only financial exposure. They want ounces. They want bars. They want something outside the banking system. And once enough people think that way, the paper price has to keep negotiating with physical reality. So as we wrap this up, my view is simple. Silver is volatile, silver is crowded in places, and silver can absolutely fall hard when leverage gets flushed. But the confirmed data still points to a market with tight deliverable stocks, concentrated shorts, heavy paper exposure, and a structural supply problem that has not been solved by one price correction. That does not mean panic. It means pay attention. It means verify numbers before repeating them. It means stop using bad claims when the good evidence is already sitting there. And it means if you choose to own silver, understand why you own it. Not because someone gave you a collapse date. Not because somebody screamed that every warehouse is empty. Own it because you have studied the difference between paper exposure and physical supply, because you understand counterparty risk, and because you believe hard assets still matter in a world where financial promises keep multiplying. Leave a like if this breakdown helped you, subscribe if you want more straight silver analysis without the circus, and let me know in the comments whether you think this delivery pressure is temporary or the start of a much bigger repricing. Nothing in this video is personal financial advice. I'm sharing research and market interpretation for educational purposes only, so always do your own work, understand your own risk, and make decisions that fit your own situation.